I would rather do 10 deals a year than 2 smaller ones and just, wait for the rest of the year to try and find those really big ones.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we have Axel Ragnarsson here. Super excited about this one. Quick backstory. Actually, the first deal I ever got into on the active side was with Axel and his team. So super excited to have him on here. A few years back, we've become close friends since. So I'll let him give himself an introduction and we can go from there.
Appreciate the invite, first of all. It's been a while since that first one. I mean, a lot of fun stories around those early deals for sure. Background on me, grew up in southern New Hampshire, first 22 years of my life in New Hampshire up until college. Then I moved down to Boston to give everybody context as to where that is for people that aren't from New England. Grew up about an hour north of Boston, right over the Mass-New Hampshire border. So always kind of in the Boston area growing up, which is where I live now. I got into real estate in college, took a bit of a different path to getting in the business, I think, than a lot of other folks in that always had a bit of an entrepreneurial background, always flipping things, buying and selling things, doing whatever I could other than getting a job to make a buck. And early college, I was buying and selling cars and got to the point where I was like, all right, I kind of, I like working for myself. How can I continue working for myself after graduation? And I think it was either an Instagram ad or HGTV that turned me on to flipping houses as a way to make money, and got my real estate license to learn real estate more. And after college, or really during the tail end of college, was trying to figure out how to flip houses and was also trying to figure out how to make money as an agent. And I quickly realized in those two pursuits that wasn't really for me. But while learning about how to do that, I learned about rental real estate, multifamily real estate, passive income, all of that, that side of the real estate business. And ultimately what that led to was me looking for small rental properties that I could buy and begin personally growing a portfolio of real estate. And in college, did a couple of deals. Then I graduated and focused on that full time while also trying to make a buck, working as an agent on the side to kind of pay the rent. And to summarize the first few years of this journey, really 2016 to 2019, 2020, it was me just hustling, finding great real estate deals, raising private capital in the form of debt. So working with private money lenders to capitalize those deals, adding value, pulling my own money out, and just growing the snowball. And right around late 2019, early 2020, just before COVID, kind of had a moment where I was like, is this what I want to be doing in this game for the foreseeable future? Or is there a different path that I want to go down? And I wanted to do bigger deals. I wanted to start raising capital to help do those deals. Wanted to expand outside of just New Hampshire, which is where I was doing deals at the time, as I was living in Boston, so kind of within an hour of Boston. And I had a portfolio of 60, 70 units myself, and was like, I want to get to hundreds of units. I want to build a real estate company. I want to scale this. And that led me down the journey of raising investor capital, which is obviously what we're going to chat about today. So started doing things like starting an Instagram page and starting a podcast and starting to meet investors. And late 2020, started raising a little bit of money for other people's deals that were doing larger deals. Throughout 2021, took down some deals that I was on the sponsor side that we were operating. Did some deals in other markets such as Florida, and continued to scale in New Hampshire as well. And around that time, we started a property management company, late 2020, to manage everything we owned in New Hampshire, because we wanted to control that part of the process. Started doing more deals in New Hampshire, and really from 2020 to now, end of 2023, the business started to scale, started buying a couple hundred units per year, started raising investor capital to capitalize those deals, started working with more partners. And ultimately what that's led to is a business to where we own and operate roughly 300 units in New Hampshire, primarily small to mid-sized deals, 5 to 50 unit deals. We own a management company that manages all of our own units and also manages some third-party units. And then we have a couple of deals down in Florida as well. And, did some other fun stuff like the podcast as well along the way. And that brings us up to today. And goal is keep doing more in the markets that we're already in, continue sourcing great deals and raising the capital to operate those deals, continue growing our infrastructure to keep our arms around the whole thing, and meet more people that have deals and have money.
So I think something that's different about you versus likely a lot of people you'll hear on this show is that most people are really fixated on the institutional like deals, the 100, 200 unit plus multifamily projects, or 10 million, $20 million plus commercial projects in general. And I think you found a really good niche in what you're doing and targeting these smaller deals that, in my opinion, likely a better value and potentially even lower risk. The issue I've always found personally as a capital allocator is that finding great partners who are doing deals sub 50 units is really tough, both in terms of the operations from the management side of it, but also the people who are actually running the projects themselves. On your end, why did you kind of choose to go down that route of deals that size? And also, how do you manage them really efficiently without on-site staff, without people in place to go help support you like that?
Yeah, I think it can be challenging to operate a business with the focus that we have, and there are a couple of reasons why we went down this road. One was that was what our market more or less dictated in terms of what was available for us to buy. So if you look at New Hampshire, there's 3 major regions, counties in New Hampshire, and in terms of the population of those counties, anywhere from 100 to 250,000 people. So small areas, right? And if you pull a data list of all of the larger assets, which in terms of New Hampshire pricing, we would define as 75 plus unit deals, that crosses that $10 million asset value mark, which I'll define as where we start to get into it's more of an institutional size. I mean, really institutional is like 30 mil plus, but in terms of a larger size, I'll define as 10 million. There's just not that many deals to pursue. So in order for us to stay active, we kind of had to look for smaller deals. And we took that same approach down to Florida as well when we started looking for deals in Florida, because we knew how to operate those deals, and that was something we had experience in. And it's not as if we won't look for larger deals, but in terms of how we stay active and where we consistently find value, it's in these small portfolios of 20, 25 units, these small buildings, 25, 30, 40 units. I still very much believe in just personally investing in real estate, like me, just Axel, going out there and buying an 8-unit building, a 10-unit building, because that has the most meaningful amount of, or the most meaningful impact to my own balance sheet, to my own personal passive income cash flow on a monthly basis. It's the most predictable. My North Star as a real estate investor is still to build a portfolio of assets that I just personally own, no investors. I have decent equity in 2, 3, 500 units over time, which creates massive wealth and massive income from a monthly standpoint. So it all kind of serves that vision that I have, right? And I think that there are oftentimes commonly parroted advantages to doing larger deals, as you just mentioned. More efficient management, you're dealing with more educated players from a service provider standpoint, management attorneys, brokers, et cetera, counterparties in a transaction. But so many of the deals that we do are direct to seller at such significant discounts that we've de-risked the process so significantly for us, and then by extension our LPs. So for example, we closed the deal in July of this year, July of 2023, 45 units. It was a $6.5 million deal. It appraised at 8 during the contract while we were under contract on the buy side. And if we were to sell it now, we would get offers mid-8s, high-8s, and we've renovated a third of the units. We haven't even deployed that much capital from a CapEx standpoint, maybe a few $100,000. And that was a direct-to-seller deal from a distressed owner, from somebody who was mom and pop that just wanted to retire, whose management company was taking them for a ride. And we get those deals through direct mail, through all of these active, more active methods in terms of generating leads. And that's something that is so de-risked for our passive investors. But then the conversation becomes, all right, well, what's the benefit of you doing that as a sponsor? Why would you focus on that? It's just smaller, numbers are smaller, you're making less money. But because these are the types of deals that we focus on, we're comfortable structuring the deals in such a way that gives us a little bit more upside, right? That's a deal where we had a higher pref in that deal, and we also are taking a higher percentage of the upside. So instead of doing a traditional 7-7 pref or a 70-30 split, which you see on a lot of these larger deals, we're structuring that deal with a 9 pref and a 50-50 split. And our investors like that. They're getting the first 9% in terms of what we distribute, and then when we return capital, they're receiving that first 9% before we get into our promote. We're still able to project returns that align with a lot of the larger deals that these folks would look at, but we get a higher percentage of the upside, and knowing that we're going to be able to deliver capital back in a shorter time period as somebody who's doing a larger transaction, we get into the promote more quickly. We own a more meaningful percentage of that deal for the long term, which aligns with what our goals are. And a couple of other things I'll touch on strictly from an LP standpoint. And this is what I always talk about with our LPs. Smaller deals are, just by the nature of being smaller, easier to execute a business plan on from a timeline standpoint. The longer it takes to execute a business plan, the more things can go wrong, whether it's related to that deal or whether it's more macroeconomic. Renovating a 200 unit complex is like turning a cruise ship. Like, there's a lot of work that goes into that. And there's a lot of risk. There's more risk relative to doing the same, implementing the same business plan in a 50 unit building, which you might be able to get through in 12 to 18 months if you're going to, assuming you're renovating all of the units. And as a result of that, we're able to just go from close to completion in a shorter time period, therefore reducing a lot of the variables. And the other big thing that I also mentioned, and then I'll wrap it up because I know I'm probably rambling here, is the financial strength of a sponsor is really, really important for you as an LP, putting yourselves in an LP shoes. If I were to go out there and buy a 300 unit asset, and I misprojected my capex, and we're going over our budget on all of our unit renos, and we're kind of tapping into our reserves, and we're running out of reserves, that's a really meaningful amount of money for one person to try and step in, one sponsor to step in and make a member loan or make a contribution and try and bridge that gap. And it's much easier to find yourself in a position, or much more likely, I should say, to find yourself in a position where you're being capital called as an LP if you're dealing with a very large deal with a sponsor that doesn't have a commensurate balance sheet or liquidity to that deal. Now, when I go out there and buy a 40 unit deal, we already own 300 plus units in this market. That's small relative to my own personal balance sheet, net worth, et cetera. And I'm more able to, let's say, make a member loan if for some reason we have some problems with that deal. And luckily, this isn't a common issue that we have. But the sponsor is more easily able to step in on a smaller deal relative to their experience versus the inverse of that, which if you're an LP, that should be music to your ears because it's mitigating the risk that the deal is going to find itself in jeopardy if there's some kind of problem. And I think that's a topical conversation for a lot of folks that are passively investing in deals right now, because unfortunately, a lot of sponsors aren't in that boat. And therefore, that's why we like the smaller deals, and we do a higher volume of them. And yeah, it creates operational drag on the business. Doing a higher volume of smaller deals just takes more work than doing a lower volume of larger deals. But I personally just want to keep doing deals in New Hampshire, which is a market that I absolutely love. I love the discounts that we're able to secure on these small deals. And I'm a bit of a crack addict in the sense that I would rather do 10 deals a year than 2 smaller ones and just wait for the rest of the year to try and find those really big ones. And I'll round it out with saying long-term focus, probably larger deals. But right now, this is perfect for our business. And in the future, I'm still going to do these deals. I'll just buy them myself instead of raising capital when I'm in a financial position to do so. And ideally, we focus on larger ones from an investor standpoint. But that's just kind of where we're at in the journey right now.
Yes, that was a lot. But I think when you look at the smaller deals, you had a few really big points on there. One is the sophistication of seller. When you're buying a deal that's $10 million, $30 million, 100 units plus in a bigger kind of tier 1 market, you're right. All of the people involved in that deal are of typically a higher qualification to be there, whether that be education, experience, meaning that you're very less likely to get a sizable discount because people know what their assets are worth. The true value you're finding is by marketing to sellers that likely either plan to go retire, right, and kind of move along. They may go down south, right, out of the cold weather. They may just be not wanting to go deal with a project like this and not knowing what they have in their hands. So the basis you're getting in those projects is huge when looking at the built-in buffer you have for things to go wrong, right, or things to go right, and kind of all that becomes upside as well. I also like the pref structure you mentioned too, right? So for the investors, if you're cycling their capital really quickly, right, the way I view pref is that if the deal is going to be a shorter time period, you want the pref as high as possible. There's simply an inverse equation with how much pref you give and then how much equity beyond that pref the investors have. So for you, if you can go cycle deals in 12 to 18 months in terms of a refinance or exit because the basis you have on them, offering a higher pref to investors, one, is a meaningful thing to them, right? It's appealing to that factor as they're compensated first, right? Second, it incentivizes you to get out of that deal really quickly in terms of clearing out the capital account so that your promote kicks in and you actually own far more of a deal, even if that deal is smaller. So your piece of the pie becomes far bigger from looking at that structure. I think for you too, it helps a lot that you're so hyper-focused in one bigger market or kind of one core market, so that you can really focus on, what goes on, what are things worth, all the relationships you have between your PM company and how you operate those assets. And I think all that makes a lot of sense. I think it's just a unique perspective from someone who primarily sees bigger deals in front of them really frequently, right? Kind of seeing someone who actually manages smaller deals really efficiently. I think there's a huge value in doing so.
Yeah, I mean, as investors, we look for inefficiency, right? And one of the most inefficient segments of the market is this sizing, right? Especially when you're in a market that isn't necessarily a core market. Like if I was looking for 5 to 50 unit deals in Boston, I'm competing with extremely sophisticated players because it's a $300,000 to $500,000 per unit market. Go an hour north and we're playing in the 100 to 150K unit range. And if you have your management infrastructure in-house, you can have your cake and eat it too, because that's typically the challenge with doing those deals, is like finding educated folks to actually manage those assets. Well, we just took control of that process and started our own management company. We have it all under our own umbrella, and we control that part of the process, therefore removing that variable from an LP standpoint. And inefficient, the more inefficient a market is, the more likely it is that you can achieve short-term returns, right? And I think that's a really important concept from a fundamental standpoint. If you're buying large assets in a core market, you're making bets that that's a market that's going to continue to grow. That's really where the bulk of your returns are coming from, paired with efficient and quality management. It's not necessarily going to be a situation where you're oftentimes finding discounted deals, and that's not necessarily where your value is oftentimes coming from when you're buying a 350 unit asset in Tampa. Like, unless the only folks who are finding discounts on that are like the true top 0.5% players in that marketplace. And usually the counterparty is so sophisticated that they're still aware of what the property is worth. So therefore, by investing in that deal, you're investing in great management and then long-term growth of that market, which usually takes place over a slightly longer time period outside of the crazy market that happened from 2020 to 22, where, insane rent growth. Outliers aside, that's typically where you're finding the value. In our market, we're creating it in the short term by investing a little bit more time in the process, therefore allowing investors to realize those returns a little bit more quickly as well, versus investing in something larger in a more core market.
Yeah, no, I mean, it makes a lot of sense and kind of why you're looking to go do that. So, I'm a big advocate of these smaller to mid-sized deals. So you have the right partners in place to help manage them efficiently, right? Because your big values there are the basis you're buying them on due to a seller that either one, doesn't know what they have, or two, needs to get out of that property for whatever reason. Two, the operational efficiencies you can go bring there, right? Such as raising rents through renovations, lost lease, etc.
Thank you for tuning into the Fully Funded Show hosted by Sam Silverman. If you are enjoying the content, let's take your journey further in the Fully Funded Mastermind. The Fully Funded Mastermind offers more than just insights. It's a mastermind community designed to solve the real challenge of raising capital. By joining, you gain direct access to strategies, coaching, and a network dedicated to turning your financial goals into achievements. Don't let capital raising be a barrier to your success. Visit fullyfunded.capital to explore how our mastermind community can pave your way to financial growth.
But I want to kind of shift gears as well to kind of how you've grown your personal brand for raising capital. You've done it in two really big ways, right? One with the podcast and two with the Instagram channel. I think most people, try and pick one or two kind of outlets for their content creation. How'd you land on those two pieces of it for you? And kind of how'd you get it off the ground? And then also, how does it impact your business as it ties to raising capital and getting deals done?
Yeah. So, for just the listeners' context, right? At Multifamily Wealth is the Instagram account. Multifamily Wealth Podcast is the podcast. Started the Instagram account before the podcast. This is late 2019. So 4+ years ago or so, 4+ years or so ago. And when I started it, it wasn't necessarily to raise capital. I was just starting it because I wanted to talk about the journey that I was going on, right? Like buying deals and trying to grow this business, and also to connect with other people that were kind of doing the same thing. And really, I wanted to use it as like a networking tool. And then over time, after doing it consistently, the follower base started to grow, and I realized, okay, there's a monetization road here, which might be helping to raise capital. And I think fundamentally speaking, if you're going to start doing this, you have to do it out of a place of personal interest. And when I say this, I mean starting an Instagram account and getting active on social media. I think it's really challenging to start going down the road of getting active on social with a pure focus on I want to monetize it this way. I think you kind of need to do it as a way to meet new people and as just an outlet for you to talk about what you want to talk about, right? Your personal interests, as it relates to your little segment of the real estate investing world, whether it's your asset class, your geographical area, et cetera, your story as it relates to where you came from, all of this, because it requires a lot of consistency over a long period of time. And it's hard to maintain that consistency if you're always thinking about the end game, right? You kind of have to like the process if you're going to get really active on a social channel. That's my 2 cents. And it's at least that's the approach that I've taken over the years as I've grown it. And it was the same thing with the podcast. Like, podcast is great, but you have to realize that you're going to do it for a year before you see anything, right? And most people can't rationalize doing 52 episodes of a podcast before really having any results. And that's what I did. And I even had an Instagram following of 6, 7, 8,000 at the time, which you would think of very targeted followers is enough to push listeners to a podcast. And it did to an extent, but it wasn't really that meaningful. I just did it because I really enjoyed speaking with people in real estate and learning more about what they were doing. And I selfishly used it as a platform to learn more about how to make my business better, right? And I was just bringing on people that were ahead of me in the game. So I think it's critical to be in love with the process, and it's critical to have an authentic voice and to not parody other people's content, right? You need to talk, you have to produce content and communicate in such a way that aligns with your values, aligns with, how you view the business, what you care about, et cetera. And then that's how you start to stand out. And so all of that aside, in terms of how I started and grew it over the years and just doing that consistently for 4 years now, and the podcast for 3, from a monetization standpoint, I started to look at it through the lens of, as I started to raise capital, I was like, first, I'm going to start with my family and friends, as everybody does. Couple of family members who are interested in writing, $50,000, $75,000 checks, not enough to really get you anywhere from a capital raising standpoint. I came from the real estate world, so I didn't necessarily have the W-2 network of high income earning folks that I could go to, like, a lot of folks to get into the capital raising game. And even just in general, from a personal network standpoint, I was, mid-20s. All of my buddies from college weren't really making enough money to throw at real estate yet. So I was like, I kind of have to go to these folks over here to raise the money. And, and maybe I'm getting outside of what you're asked, but I'll bring it back. But I realized that the podcast and the Instagram were a perfect conduit to just sharing information about the deals that we were doing in real time. Hey, this is what we bought it at. This is what we spent on CapEx. This is what it's worth now. This is where we buy. Here's a unit reno before and after. This is where we took the rents from and brought them to after these renovations. Doing that consistently and just pushing everybody to an email list, right? I think a lot of us are on the same page as it relates to, like, the goal is to get people on your email list so you can nurture them over time. And then I started consistently sending out newsletters, consistently sending out content to the email list to keep people informed as to what we were doing. And that's really what started to drive people into our deals when we actually started going out there and raising capital. I'll stop there in case you want to take it somewhere else, but that's really how I leveraged both of those platforms, was a pure funnel to an email list. And we grew those platforms by just being authentic and talking about our story and kind of documenting what we were doing.
Made a few really good points. I think the first one to go touch on was when looking at kind of the sharing stuff on social media, and like whatever platform it is you choose to build your brand. Like for me, mine was LinkedIn. The first while of doing it, your time spent versus your actual return is comically low, like insanely low when you look at, okay, what's my hourly rate? And I'm big on doing time audits and digging in there. But like, you dig into what's your hourly rate when you first start posting on social media and answering comments and engaging with people, you're like, wow, this is actually horrendous when you look at it as a purely monetary type concept. When you think about it from the long game, like for you, it's getting the education for yourself from people who are ahead of you to go, hey, I can actually go offer you something now to go speak with me, right? And have an hour conversation of, what are you doing? I can ask you questions for the whole time. And you're okay, that probably would have been a $1,000, $2,000 coaching session, right? In terms of consulting. So you have that piece of it. You can actually make the offers to someone. I think for you as well, having deal flow, people potentially pushing deals your way, but also it's building credibility, right? All that future credibility that you'll have when talking to investors of, you want to see how I think and how I operate and know the person you're getting in bed with for 5 to 10 years. Here's my Instagram page. Go look at all my posts that walk through exactly what we're doing and how I think, and make a decision from there if it's something you want to go partner with. I think part of the big value of social media is that you need to be conflicting in some way, right? Have a strong point of view on some things that allow people to have opinion on you, whether positive or negative. And I think if it's negative, that's fine, right? They move on. But if it's positive, they're much bigger believers in you than if you didn't have those things behind you. So I'm a huge believer in that standpoint of it, is that the social content does two things. It can either, one, help grow your brand, but also two, go back for credibility so people can feel as though they know you much quicker than when they actually talk to you. Like, for example, I'm sure you've been on phone calls where that person you never talked to in your entire life, and they feel very comfortable as if they know you prior to that phone call.
100%. Yeah. I mean, the deal that I mentioned earlier that we closed over the summer, I think, 600K out of the $1.5 million that I raised personally for that deal, I had a partner that raised the rest, like, came strictly from the podcast. And one investor in particular was like, hey man, listen to your podcast for a couple of years. I got 250K, like a massive investor, like a really meaningful investor. And it was just some older guy in Colorado that was like, dude, I love your stuff, like, down to get involved. And there was no diligence beyond that. The diligence was me doing the podcast for 2 years and him being like, his head screwed on tight. And that's pretty much it.
Yeah.
A couple questions about the deal and you're already there. So you're shortcutting that roadmap of building trust in a lot of different ways. The other thing too, that, and it's similar to what you just mentioned, I'm a huge fan of doing business with people who have something to lose, whether it's a general contractor, whether it's a property manager or a broker. It's likely that somebody who's taken the effort to carefully build their public persona has more than, has something to lose comparatively to someone that hasn't, right? They have more on the line in terms of they need to deliver on their
100%.
commitments. That's not the only thing as it relates to vetting who you work with, but like, it's a big part of it. You want some recourse in terms of if they don't deliver. Okay, so their persona might take a hit. If you invest with them and they lose money, like, there's a lot more on the line than somebody that has no presence and can kind of start over or build one post screwing up with your dough or, that relationship. So there's all kinds of reasons. And it's one of the only activities that's scalable. So it's like, if you think about the work you do on a daily basis, what am I working on every day that's scalable in nature in terms of more specifically defining that? What work am I doing that, if I do this work today, produces outsized output in the future? And it's like, social media is a perfect example of that, where, yeah, the first year you're probably feeling like you're wasting your time, but that's the only work that, the longer you work on it, the more people you get in front of, and your input stays the same over time and your output drastically grows. And the more work you can do that's scalable in that vein, like, the larger the long-term payoff is going to be, as you mentioned, right? So that's how I would always come back to thinking about it in that fashion, which is the only way to stay sane than getting it off the ground.
Yeah. People don't realize that too. Like, they want a shortcut of, I'm worth this much, right? And like, the activities you're doing, part of what I think makes people successful entrepreneurs, whether in real estate, raising money, or whatever field they're in, is understanding that your first period of time in doing something, you will be grossly undercompensated for it. But if you stick with it in that sense, you'll be compensated far more than everyone else for that risk and effort you put into something that wasn't guaranteed in a return. So I can give an example of that too when looking at that side of it. My first year raising money, I probably spent 2,000 hours building an investor list of cold calling, LinkedIn, etc. Right? That same list now pays me and will keep paying me for the next 5, 10, 20, 30 years of people that I build relationships with. They're not on an email list. So when a deal goes out, they can opt in, right? So it's that work you do that'll pay you in the long term over and over again is really important. Another big point you made too, that I say all the time, that is actually, when you're doing due diligence in a deal as an investor, you'll typically ask the question, how much money do you have in the deal as a sponsor yourself? For me, I don't care. And the reason why is, I like to give an example, kind of like using you as the example, I'd rather someone who has these two things. One, a meaningful social presence in which they spent tons of time building, where reputationally it's far more of a hit than any amount of money they can go put into the project themselves, right? If Axel and I lose money on a deal personally, we lost, say we put in $1, that deal went south, we lost $1. But if that deal goes south, we have investor capital there, right? Or something that we didn't handle the right way, or whatever happened, we lost money. The hit to ourselves personally, right? Especially if there's any kind of ethical or operational type thing that could have been avoided, is a massive multiple on that same dollar. So in turn, I'd rather someone who has a big social brand where if things don't go the right way, or if they act unethical in any way, right, or cut corners in a certain way, that their social brand hit will cost them far more than any amount of money they could have put into the deal. And second, I'd rather someone save that money in a scenario like Axel was saying, where they can go make the first contribution themselves in a downturn or in a negative situation versus asking the investors. In really large projects, it's tough to go take that bullet yourself entirely, or depending where you are in your career, especially if you're doing a volume of deals, right? But if you can have that liquidity, being in a stable financial situation as a sponsor is a must for investors. You don't want someone who you're giving your capital to who needs that deal to go perform, to go feed their family, right? Like you want them to be in a stable situation where they can act rationally versus emotionally in the business plan and think longer term versus thinking, how do I go save myself for a period of time?
Last thing on that too is like, if you see a sponsor contributing a very meaningful percentage of the overall equity required to close the deal themselves, it's usually an indication that they don't have the ability to raise that capital, or they had some trouble raising the money. Maybe not, I shouldn't say usually, but sometimes it is an indication of that. Where it's like, all right, they're bringing 25%. Okay, that in general is a very large number comparatively to the standard 10 that a lot of folks kind of look for. But it might be because they had some trouble raising the dough. And maybe they're early in their journey and it's not necessarily indicative of the quality of the deal, et cetera. Maybe they're still working out their investor base in terms of meeting investors and all of that. But that is relevant. And you would rather your sponsor retains that money in their bank account sitting there to stopgap any issues, as you mentioned, versus tying it up in the deal itself. So we both have contrarian opinions on that, where a lot of folks are like, the bigger percentage of equity they contribute, the more skin they have in the game, the less risk it is to LPs. I don't think that's necessarily true.
No, I don't agree. I'd rather have that money to go potentially save deals, be financially stable, get more subsequent deals under contract for hard earnest money as well. So I'd rather also have employees too. They have to go keep payroll on hands, right? Like versus it being a one-man shop who's just doing deals, right? So like I like seeing the full team behind it. But yeah, I think it's, you offer a really unique perspective on the social media side of things, the small to mid-sized deals too. Like I think people get so fixated on these big deals that are more visually appealing at times that, I can give an example. I probably invested now in 62, 63 syndications or funds, right, in private placement type deals. The best investment I've ever made dollar for dollar was a single family house I bought, like unintentionally. Yeah. And it's just saying that the bigger the deal doesn't mean the bigger the profit for you as an investor. It's all what you own of that deal and how likely that business plan is to be achieved. So I think it's having a different perspective on being open-minded to deals as well. And there's huge value in these small, medium-sized deals if you can find a good partner like Axel to go work with on them, who has both the deal finding and management side of it really down and looking at that side of the things as well. So Axel, on your end, how can people get in touch with you and kind of why should they reach out to you?
Yeah, so if you're interested in investing or learning a little bit more about what we do as a company and the deals that we're working on, alignedrep.com/invest is how you get on our list. And then obviously alignedrep.com if you want to go check out the rest of what we got going on. Like I said, at Multifamily Wealth is the Instagram account, consistently posting on there. So if you're interested in learning more about what we do, that's a great place. Multifamily Wealth podcast geared towards everything multifamily, specifically for those who are operating deals or raising capital for deals. And if you just want to email me personally, Axel, AXEL, at alignedrep.com.
Cool. Yeah, we'll make sure to link all that in the notes as well. But yeah, thanks for coming on. Really cool to see what you've done the last few years.
Yeah, appreciate it, man. Thanks for the invite.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow. Share with your investing pals and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.